TV18. Our alpha manager of the day is with us. Amit Gupta is Vice President and Fund Manager at ICICI Securities PMS. Amit, good to have you with us here. Thank you very much for your time. A little bit of volatility today, but mostly the market's been up. Are we finally putting, all the mayhem and downside behind us? Is it looking a little better as you look ahead?
So I think the levels are good, no doubt about this. I mean, if you look at the last 2 years now or more than that, the mean price of the market is around 17,000. And this time, so we have come below the 5-year, price to earning average also, because that was somewhere around 18.5. And now at 17,000, actually, we are somewhere little lower than 18 times, because financial year 24 earnings looks like it will be somewhere close to 950 EPS. And that is where actually the markets are looking little lucrative. And if you see the premium over the emerging markets, which was higher, more than 100% premium, now it has come down to 60%. So that is where my sense is that when the dollar is topping out, because in this whole scenario, you have not seen that dollar is shooting up. So when the dollar is lower, so it is around 103, 105 dollar index, it looks like that when the things are getting stabilized, though the central banks are very agile this time. So if the things are getting stabilized, the money flow from FIIs, my senses will start into the emerging markets. And when the Indian markets are getting more attractive and their expensiveness is reducing, so I think India can be one of the good bets. And some of the heavyweights have come down to good levels now. That is what I feel in the large cap space.
All right. Hi, Amit. Good afternoon. As we speak, Amit, the markets have moved to the high point of the day. The Nifty Bank, that's making the move because today's a financial Nifty that has its expiry that's playing out. And that's clearly the one that's moved to around 40,000 odd. 20 DMA at 250 points away. So we've crossed the 200 DMA on the Nifty Bank. Let's see whether or not we can get past, the 20 DMA as well. But Amit, you're sitting on cash. Normally, I think as a portfolio, it'll sit between 0 to around 20%. As of now, what is the cash level you're sitting on? And have you started deploying that money? If yes, which sector are you looking at?
So we are totally deployed now, near 17,000. And that is a strategy we have been carrying actually in the previous declines also. And that has really worked well. Though market has swung actually on both the directions, above 17 and below 17. But I think these are good levels to be invested. And if you look at from the sector perspective, what we believe is that, some of the utility companies, the power stocks, they are doing much better now. Previously, we saw some of the PSU banks performing better. And now I think the money is moving more towards the utility companies. If you see, for example, NTPC, so we have inducted that company actually in the portfolio, though it has been a very low beta stock historically. But now if you see the discounts, they have already paid more than 60,000 crores. And I think that is a game changer. And that is why if you see some of the utility financing companies, for example, Power Finance, they are also coming out after 10, 12 years of period. So NTPC, our sense is from an outstanding of around 1,23,000. Now it is reduced to 62,000. And the company is moving into, the more renewable space. The number of GV actually is expanding, their capacity is expanding. So our sense is it is a well-placed company now, and it has almost a fixed ROE structure. So in this kind of volatile market, generally the money flow goes into such kind of stocks. And that is where I think power is one space which is looking good. Along with, I think the evergreen space has now become capital goods, because you are seeing that now in this financial year ending, government is almost close to now. They have done this 7.5 lakh crores of capital spending for this financial year. And the coming financial year, I think another 10 lakh crore what they have proposed, I think will be done mostly. And these companies which have sold their non-core assets and totally focused on the railway and the road focus on road capex, I think they are doing good now.
Okay, so you like some of the capex plays, some of the power plays. Got that, Amit. Let's also talk about insurance. Very interesting moves today, for instance, on an HDFC Life. Beaten black and blue, it fell from, I think, 600 odd levels in January when the budget announcements came in, fell all the way down to 450, and now there's a recovery. But do you think this is a durable recovery? And do you think the worst of these issues with their high-ticket products, whether they're behind these companies? How do you look at the life insurance?
So my sense is still the money will go into the lenders, the banking. I think the non-lenders will find it a little tough. For example, the insurance businesses, despite coming down, I don't think the valuations are too low. And that is a problem. If you look at the loss ratios also, they are higher. And that is where I think there is some period of consolidation more left into the insurance company. So obviously you had the life insurance, which had beaten down more because of that particular news of after budget. And despite today's move, if you look at the general insurance, it has not seen that kind of move. I still believe general insurance looks better going forward, actually. And that is where I think more money flow is likely to come. So it has fallen less relatively. And I think from here, so if some kind of traction comes, it can go there. But overall, what we are focusing more in our portfolios, it is more the lenders right now, particularly if you see the PSU banks. Because these are more corporate linked banks. So that is where there is more confidence. If you look at the RBI survey also recently, the corporate confidence now is almost 110, more than 110% if you compare with the pre-COVID period. And that is where if you are lending more, I think your money making scenario is much higher. And when, now the credit growth is almost 16.5%, your provisioning coverage ratio is much higher. And now we are seeing that the margin, because in the banking, now we are talking about that the margin is coming under pressure, right? So we are saying that the FD rates, which were not improving before, now they are increasing. So NIMs will come under pressure. But if you look at the personal loan growth in these banks, it has actually grown. And that is where the margins actually can pick up again in that particular segment. If you look at the corporate pricing of loan, it is also better. So that is where I think what market is expecting that NIMs, can come down. I think if some part of it does not happen and the prices are already lucrative, you will, I think, start seeing the money flow going into those PSU banks at these levels now.
Amit, is there a risk to Bangalore-based real estate companies slowing down in terms of demand? Because technology wages are likely to moderate next year. We already had news about how Wipro has cut down the fresher hiring salaries. That had been chopped down by nearly 50%. Global tech giants are laying off people. In lieu of that, do you think there is a risk to Bangalore-based technology-dependent real estate companies slowing down in terms of growth rates? And is it priced into the stocks right now?
So you are definitely right, because IT is going through a phase where there is a lot of uncertainty right now. Even you are seeing a lot of churn happening at the top end of the IT companies currently. But going forward, if you look at on a broader basis also, though in the top 8 cities, we have seen a good registrations now, more than 3 lakh units of registrations in India in the last, almost 8 months now. And I think it's a good number, which is coming up. But still, I think the real estate has to fire from all the cylinders because the interest rates are higher. I think the people who are at the age of, let us suppose, 45 years or something, I think it's really tough for them because their, the tenor will not be increased. Only the EMI will be increased because they can get only up to 58 or 60 years. So that is where in the higher interest rate scenario, some kind of impact, I think, is obviously likely to come on the real estate.
Amit, thanks very much. Good speaking with you and candid conversation. Thanks very much for being with us.